Hello there, it's Stefan Angelini. It's the 4th of April, 2023. Let's go around for another economic wrap. But before we do, if you are my friend on Facebook, some idiot has gone and tried to copy my profile, but the silly person has used the wrong name, as in they spelt my name wrong. Anyway, if you are my Facebook friend and you get an ad from me, don't add it. Anyway, here's a little economic wrap we're going to go through. What are we talking about today? We're going to talk about more taxes and whether or not more taxes are on the loom. There's been a report from the Grattan Institute that's outlined a few ways the government can make money. Now, as importantly, this is on news.com.au, so the readership there would probably like to hear this. We're going to talk about the banks battle and mainly why CBA and Macquarie might be the last ones left standing. We're going to talk about the commercial real estate sector and why a billionaire investor thinks that's going to be the next one on the chopping block. And we're going to talk about China and investing in China and why it might be beneficial to be active when you're investing in China. So if you are out there and you want to listen to the full episode, please head on over to our podcast or YouTube channel. Just search for Real Wealth with Stefan Angelini. Now, if you are staying on the line, just a general disclaimer, this is all just general information. Please don't consider it as personal advice. If you want any personal advice, please go and consult your licensed financial advisor. Guess what? We are financial advisors. The main reason we do this is because it's our job to remain ahead of the curve and to keep all the information we can have coming in, because part of our role is managing people's investment portfolios. So let's talk about the new taxes that might be on the cards. So news.com.au had a headline that said, inheritance schemes for the rich. Super tax breaks cost $45 billion a year. Basically saying that they think that superannuation is just a big tax break for rich people. So there has been a report by the Grattan Institute that has said that generous superannuation benefits are creating taxpayer-funded inheritance schemes for the wealthy. Now, they've gone on and said, what are a few ways or a few things that they can do to raise more money? And a good little quote here is, reining in super tax breaks is a responsible way to boost government revenues in a world where government has committed to higher spending on defense, healthcare, aged care, and disability care. Now, the real issue around this and why they're bringing it up is because the 2022-2023 year in the federal budget is expected to be in the red by almost $37 billion, with the shortfall set to soar to about $50 billion in the year 2024-25 or 2025-26. So it's been a bit of an alarm bells around why they need to raise extra money. So here's some of the recommendations that the Grattan Institute have made. Some of the reforms should save about $11.5 billion a year. So one of the ones is, let's tax people that earn more than $220,000 a year, 35% on super taxes when they put money into super. So at the moment, if you earn more than $250 a year, you will be taxed 30% on your super contributions. And if you earn less than $250 a year, you get taxed 15% on your super contributions. Now, they've said if you decrease the income to 220 and increase the tax to 35% instead of 30, then you should raise an extra $1.1 billion per year. Doesn't stop there. They said, well, you can actually put in a deductible contribution of $27,500. And they said, why don't you decrease that to $20,000 a year? That should only impact around about 1.3 million Australians, and it should save about $1.6 billion a year. Yeah, okay, fair enough. Makes sense. And then they also said, well, why don't you abolish the tax-free pension and make everything 15% taxable? So no more tax-free. Everything's taxed at 15%. They said, well, this will actually raise $5.3 billion a year. But this is going to make people say, why would we use superannuation? Why would we save? And if you're not forced to save into superannuation, what's to say people won't just spend their money? The main reason for super is so that people can self-fund their retirement and not have to rely on the government to pay for their retirement. And therefore, they don't have to use things like the age pension. So that's one of the downfalls that haven't been calculated here. So what will be the extra costs in terms of government subsidies that may be impacting future Australians? Now, while this mainly will benefit younger Australians, it will impact older Australians. But guess what? When those younger people become older, they will not get the tax breaks that are currently there. So these old people that are getting these tax breaks have been paying taxes all their life. So, it'd be really interesting to see what actually comes into play and if they take anything on board. I could imagine they might take a few on board because they do need to raise more money in taxes. Anyway, let's talk about banks. So if you haven't seen recently, there's been a bit of a bank war on banks trying to retain clients just because of not many new lenders out there, not many people being able to refinance. So basically, what an article in the Financial Review has said is that they believe CBA and Macquarie will be the last two banks left standing in a fierce battle to retain and obtain clients. Now, there's been a lot of competition, and that's what actually, so the Australian Financial Review and a lot of bankers have said it. The reason being it, so a bit of background information, returns have been driven down to a level that's not sustainable, says one senior banker. Competition battles take time, but I think it will eventually come down to a contest between CBA and Macquarie. So that's directly calculated. That's directly taken from the article. Now, UBS have done a bit of a calculation and said, if they originate a home loan and it comes through a broker channel, so they pay a broker commission with a cashback offer, and the client actually gets out of the loan after 2 years, the internal rate of return is negative 58.4%. So the 58% down if that happens. So as you can see, a lot of smaller banks are going to go, it's not worth it, but there's still a lot of the big banks out there that have these cashback offers. And everyone is predicting that ANZ, NAB, and Westpac are already starting to push back. Macquarie being largely online or broker-driven, but CBA just with their large network. So offering cash to stay, decreasing rates, taking losses just to maintain client loyalty. That's what a lot of these banks are doing. And they believe CBA and Macquarie will be the last ones left standing, especially if there's still another $400 billion odd to be refinanced towards the end of the year. Right, let's get into commercial property. Big space in Australia. There's a billionaire named Leon Cooperman who said that you should be worried if you're in commercial property. And he's basically saying that because of recessions are on the cards, he's overly cautious. And he believes that because of the recent financial issues, banks will start to tighten the lending standards, which will first affect commercial real estate. And he says that will be the next market to hit turmoil. So watch out if you're in commercial property, and just make sure you're talking to all the right people. In terms of China we know is a great market to invest into. It's done well over the last few years. Done terrible over the last 2 years, but long term it's done okay. It's started to open up back up now, and so people are talking about it a lot more. But let's just look at the issues around investing in China. So China's been a pretty tricky place to invest for foreigners. So there's basically, let me tell you why. There's been a multitude of factors and nuances at play. There's been varying styles of government, varying styles of business dealings that you don't know about, socioeconomics, language barriers, accounting and reporting issues. So basically, if you want to be good at investing into China, you need to be all over economics, foreign policy, finance, accounting, and social affairs, among countless different things, and all in a foreign area. So given these multitude of risks, you can invest into China through ETFs and other kind of passive assets. But there's been a really interesting article that says, if we were to do it, they'd probably be doing it through an institutional private fund. And the reason being is because these fund managers have a deep understanding of local market dynamics, so they can dive deep and they know where to go. They have teams on the ground to actually create your own due diligence. So a long time ago, back in, I think it was 2008, or there was recent examples where Chinese public listed companies were raising money and they had factories that were doing nothing. So if you had a team on the ground, they could go and look at these things. And also they've got 24/7 infrastructure, trading infrastructure in place, meaning if they need to get out of something, they can get out of it, and they can get out of it fast. So that's one of the reasons to stay active in China. That's a little economic update today. Thank you very much for listening. Go off and have a great day. And remember, Stefan Angelini adds you on Facebook. Say no. Have a great day. Cheers.